Welcome to the Deep Dive. We're here to deliver the knowledge you need, and fast. I'm Lex.
And I'm Vera.
Today, we are diving deep into something really specific but absolutely critical for Australian business owners, C-level executives too. We're talking about protecting your business.
That's right. Specifically from quite a sophisticated threat. Physical counterfeit Australian dollars, the fake cash, getting laundered through your digital payment systems.
It's a real crossover threat. Physical fakes hitting the digital world.
Exactly. And our mission today for you, our followers of C9 and the business page, is to really drill down into the source material. We want to pull out actionable knowledge.
Actionable knowledge on what, specifically?
On how you can use financial technologies, specifically tools like Stripe and Xero, integrated smartly with custom APIs, to actually enforce your AML controls, your anti-money laundering controls.
Right, and know your customer, KYC, that's part of it too.
Definitely. It's about protecting yourselves.
Because this isn't just some abstract risk. We know the digital economy, well, it opens up huge opportunities, but also big risks for SMBs.
Huge risks. We're talking frozen accounts, massive fines, really intense scrutiny from regulators under the AML CTF Act 2006. It's serious stuff.
Okay, so high stakes. And for businesses needing to navigate this, finding the right partner for that integration is key.
Absolutely. Which brings us to our sponsor for this deep dive, C9. They are Australia's leading custom software, apps, integration, and database developer company.
You can find out more about how they tackle these complex integrations at www.c9.com.au.
That's www.c9.com.au.
Okay, let's get into the pain point first. Paint a picture for us. Say I run an online store, maybe selling artisanal goods, something like that. What does this money runner threat actually look like to me?
Okay, so think organized crime, often international. They've got stacks of physical counterfeit Aussie dollars.
Right, the fake 50s or hundreds.
Exactly. And they need to turn that into clean digital money. So they hit your online store, they use the fake cash, maybe loaded onto prepaid cards, or using other methods to buy relatively low-cost items, or just get money into the digital system.
So they're essentially washing the fake physical money through my legitimate online business.
Precisely. They exploit that gap between you taking a digital payment and the source of the funds being dodgy physical cash. They bypass all the checks the banks have for large cash deposits.
But you often hear stats, that Australia's counterfeiting rate is pretty low compared to overseas. Doesn't that mean the risk is small?
That's a dangerous assumption.
Yeah.
It makes people complacent. Yes, the historical rate, the RBA quotes something like 6.7 parts per million. It sounds low.
Yeah, neat.
But that number doesn't capture the sophistication. The fakes are getting much, much better. And the RBA itself, they've flagged, I think the source said, 11 emerging counterfeit sources just for this coming financial year, 24-25.
11 new sources. Okay, that changes the picture. It's not about volume necessarily, but the quality and the intent behind it.
Exactly. The threat's evolving. And look at what they're targeting.
What do you mean?
The $100 note. It's recently overtaken the $50 note as the most commonly counterfeited. That tells you they're strategic. They want maximum value per dodgy transaction.
And who bears the brunt of that?
Australian SMBs, small to medium businesses. They make up, 97% of all businesses? They're the backbone, but often the softest targets. They usually don't have the huge compliance departments that the big banks do.
So for that online store owner, what's the immediate fallout if they get caught up in this? It's not just the value of the goods they ship, is it?
Oh, far from it. You might lose the revenue, sure. Could be $10,000 or more from just one dodgy prepaid card scheme, easily. But the real cost, it's systemic. First, there's the broader economic impact. Money laundering is estimated to cost Australia up to $36 billion a year.
$36 billion, wow.
But for your business, it means AUSTRAC gets involved. That's the financial intelligence regulator. Suddenly you're under investigation. Your reputation tanks. Customer trust evaporates. It can be devastating.
Okay, so the threat is real, the consequences are severe. Let's talk about inaction. Why is just hoping it doesn't happen to you basically a business killer now?
Well, the biggest stick is regulation. The AML CTF Act. If you're deemed non-compliant, the penalties are, well, they're astronomical.
How big are we talking?
Civil penalties can go up to $21 million per breach.
$21 million per single breach.
Yes. That kind of number focuses the mind, doesn't it?
Yeah.
It means you absolutely have to be proactive. You can't just react after the fact.
And AUSTRAC's expectations are rising, you mentioned, especially after amendments in November 2024. What are the core things businesses must do?
There are 6 key obligations for regulated entities. You've got to enroll with AUSTRAC. You need a proper documented AML CTF program. You need robust customer identification. That's your KYC.
Know your customer. Got it.
Then there's reporting. Suspicious matters. You see something dodgy, you have to report it. Keep meticulous records. And finally, ongoing customer due diligence. You can't just check once. Especially for digital businesses, the spotlight on transaction monitoring is intense now.
Okay, so massive regulatory risk. But what about just the day-to-day operational problems?
Right, even before AUSTRAC finds you, your payment processor, like Stripe, they have their own risk engines if they see too many suspicious transactions or chargebacks.
What's a high chargeback ratio?
Or you have 5% or more, that rings alarm bells for them. They can just suspend your account. Maybe right in the middle of your busiest sales period, your entire cash flow just stops.
Ouch. Okay. That's critical. But you mentioned something else, a critical agitation point, AI Cowboys.
Yes, this is crucial. It's the danger of C-level executives or even IT managers opting for what seem like cheap, quick, technical fixes, trying to plug these compliance gaps with, let's say, unstructured code.
What's vibes coding? You used that phrase earlier. Sounds intuitive.
Intuitive is one word for it. It means developers, maybe less experienced ones, or those relying too heavily on generic AI coding tools without real architectural oversight. They bash out some code, maybe charge you $500, maybe $2,000, promise a quick integration.
And the problem is?
The code is brittle. It's not properly structured or tested for security. In this specific context, AML, KYC, it's incredibly dangerous.
How so? What are the actual risks of this cheap code?
You get security holes, big ones. Imagine your system accidentally leaking sensitive KYC data, customer IDs, addresses, because an API wasn't secured properly. Imagine the system falling over when transaction volumes spike, or just failing to flag genuinely suspicious activity because the rules were coded badly.
And these fail often.
Gartner estimates something like an 80% failure rate for these kinds of poorly planned, quick-fix projects. They create the very compliance gaps that sophisticated money runners are looking to exploit, because the system was built on a vibe, not solid, auditable engineering.
So the lesson is clear. Cheap code equals massive, potentially existential risk down the line. You need professional, audited integration.
Exactly. Which brings us nicely to the solution. How do we build that fortress? We do it by smartly combining the strengths of platforms like Stripe and Xero.
Okay, Stripe for payments, Xero for accounting. How do they work together against this specific threat?
Think of it in layers. Stripe is your frontline digital defense. It uses real-time data, powerful AI, to assess the risk of each transaction as it happens.
And Xero?
Xero becomes your forensic backstop, your audit trail. Once transactions hit your books, Xero allows you to reconcile everything, spot patterns, and trace the flow of funds in a way that stands up to scrutiny. They complement each other perfectly when integrated correctly.
Let's break down Stripe's role first. What specific features help fight money runners converting fake cash?
Stripe's really powerful here. Its core is Radar. That's their AI machine learning system. It crunches data from millions of transactions globally to give you a risk score for each payment.
So it flags dodgy payments.
Yes, based on loads of signals. Things like device fingerprinting. Does this device have a history of fraud? Velocity checks is someone trying to make too many transactions too quickly. It also handles 3D secure authentication and can screen against sanctions lists. And they're constantly improving it. Recent AI updates reportedly boosted fraud detection by up to 30%.
Okay, so Stripe catches a lot at the gate. How does Xero then add value? It's primarily accounting software, right?
Right, but think forensic accounting. Xero uses automated bank feeds to pull in transaction data. Your finance team can then match, code, and reconcile entries efficiently. The magic happens when the data coming into Xero is enriched by Stripe's risk intelligence via a custom API.
Enriched. What does that mean in practice?
It means Xero doesn't just see transaction $50. It sees transaction $50, risk score high, IP address from high-risk geolocation, device fingerprint matches, known fraud. Suddenly, Xero isn't just for balancing the books, it's highlighting behavioral red flags, like lots of small, high-risk transactions being grouped weirdly. That points to laundering.
And that enrichment, that connection, that's where the custom API development comes in, the professional integration you mentioned.
Exactly. It's not out of the box. You need developers who understand both platforms and the compliance requirements to build these smart links.
Can you walk us through maybe the key integration patterns, the technical execution bit that C-level decision makers need to grasp the value of?
Sure. There are three main high-impact patterns we see. First is webhooks plus transaction enrichment.
Okay, what does that do?
So when a payment happens in Stripe, like payment intent.succeeded, Stripe sends an automated message, that's the webhook. Our custom API catches that message. But before just passing the basic payment info to Xero, it calls back to Stripe to grab all that rich risk data, IP location, device details, radar score.
And then it syncs to Xero.
Exactly. The full enriched record goes into Xero.
Why does the accounting system need IP data? How does that help stop fraud faster?
It builds the context for your audit trail. Imagine 5 small, separate purchases, clear Stripe individually. In standard Xero, they just look like 5 sales. But with enrichment, Xero might show they all came from the same high-risk IP block, or use similar stolen card details. It connects the dots. This approach is great because it also reduces false positives, legitimate customers getting flagged by maybe 40%, letting you focus on real threats.
Right, more signal, less noise. That makes sense for efficiency. What's the second pattern?
Automated reconciliation rules within Xero. Once the enriched data is in Xero, we can set up smart rules. For example, automatically flag any transaction over, say, AUD $500 for manual review, or flag unusual payout patterns, like multiple small amounts going to the same new bank account.
So it automates the first pass of checking.
Precisely. Your finance team isn't wading through everything. They focus on the exceptions, the high-risk items identified by the rules. We've seen this cut manual reconciliation effort by as much as 70%.
Huge efficiency gain. And the third pattern, you mentioned KYC compliance earlier.
Yes, the AML KYC hooks. This is about integrating identity verification before funds move, especially for payouts. You could use something like Stripe Identity. The custom integration builds the check into the workflow. Is this recipient account verified? If not, the payout is automatically halted. No money moves to unverified parties.
That sounds like a critical control point, fulfilling that customer due diligence obligation before the money walks out the door.
It's essential, a real checkmate move against certain laundering tactics.
Okay, this sounds comprehensive. For the leaders listening, let's summarize an implementation checklist. We started with physical counterfeit cash, so the solution needs both digital and physical defenses, right?
Absolutely. Digitally, you need solid KYC onboarding, especially for higher risk accounts or transaction types. You need that rigorous AML transaction monitoring, setting rules for things like daily velocity, $10 K threshold maybe, or weird geolocation patterns. And you need tight payout controls, maybe whitelisting approved bank accounts requiring dual approval for new pays.
And the physical side, back to the actual cash handling.
Non-negotiable, this is critical. You must have and enforce a rigorous cash handling policy. Your staff need training on the RBA's recommended security features for Aussie banknotes.
The polymer feel, the clear windows.
The UV features, the slightly raised intaglio print. They need to know how to spot a fake before it even gets near your digital systems. Digital defense is vital, but it doesn't replace basic physical checks at the point of interaction if you handle cash at all.
So, a combined arms approach. If a business puts all this in place, the smart integration, the policies, how do they know it's working? What are the KPIs?
Success here is measured by lower risk and higher efficiency. You'll be aiming for a fraud detection rate consistently above 95%. Your reconciliation accuracy in Xero should be hitting 99% or better. And critically, that chargeback ratio needs to stay low, ideally well under 1%. You track these metrics regularly to ensure the system stays tuned.
This level of tailored integration, it sounds like it needs careful planning. Why is skipping that initial discovery call you mentioned, even a short one, such a bad idea?
Oh, it's often a recipe for disaster. Skipping proper discovery is the #1 reason projects go off the rails with scope creep. Sources suggest that affects, 50% of IT projects?
Half of all projects. Wow.
Yeah. A structured chat, maybe 30 minutes, maybe 60. It forces everyone to get aligned on the exact requirements. What's your specific payment flow? What are your biggest compliance worries? Nailing this down prevents costly mistakes and rework later.
So clarity up front saves money and time down the track.
Absolutely. And it allows for a smarter, staged implementation. You don't have to boil the ocean. You can identify quick wins, maybe integrate Stripe Radar first for immediate fraud reduction. That delivers early ROI, builds confidence, and might even help fund the next stage, like building the more complex Xero reconciliation APIs.
It makes sense. So when Australian businesses are looking for a partner for this kind of critical compliance integration, what should they look for?
Beyond technical skill, look for a focus on knowledge transfer. Does the partner plan to properly document everything? Will they train your team to manage the system ongoing? You don't want to be locked into dependency forever.
Good point. Empowerment, not just execution.
Exactly.
Oh.
And flexibility matters. A partner like C9, for instance, they offer a blended hybrid team model, onshore oversight, offshore development, which can offer significant cost savings, maybe 30%, without sacrificing quality. They also offer different engagement models. Project-based, dedicated teams, part-time or full-time, even just strategic consulting. You get the right skills for your specific need.
And that avoids paying a single inflated rate for everything.
Right. You might pay a different rate for a junior dev versus a senior API specialist, 80 hours versus 120 hours, for example, hypothetically. It ensures you get tailored value, not a one-size-fits-all inflated price.
Okay, let's bring this all together. The core takeaway from this deep dive seems to be, for Australian SMBs facing these sophisticated money runners, combining Stripe's real-time digital defenses with Xero's forensic accounting power, linked by smart custom APIs, creates a really robust protection layer.
That's the digital fortress, yes. And it's a crucial, but it's only truly effective when it's paired with rigorous RBA-guided physical cash handling procedures. If you deal with cash at all, you have to close both doors.
Protect the physical entry point and the digital pathways?
Precisely. It's about end-to-end security against criminals exploiting that physical to digital seam. Which leads to, I guess, a final provocative thought for you, the listener.
Go on.
Thinking about your current processes. If an AUSTRAC compliance auditor walked into your business right now unannounced, what percentage of your cash handling or digital payment processes would genuinely pass their scrutiny? Would you be confident?
That's the question to really ponder, a stark measure of readiness. Don't wait to find out the hard way via a fraud incident or a failed audit.
Definitely not. The smart move is to be proactive. Schedule a free discovery call, understand your specific risks, and start building those defenses.
You can learn more about getting these custom solutions built right from C9. They are Australia's leading custom software apps integration and database developer company.
Check out their website.
Visit www.c9.com.au. And if you found this deep dive valuable, and we really hope you did, please click that follow button. Share this with other Australian business owners, CFOs, CTOs, anyone who needs this essential knowledge to navigate compliance safely.
Stay safe out there. Until next time.